Welcome to Volatility 411. My name is Joe Tigay. I'm the portfolio manager of the Rational Equity Armor Fund, and today I'm going to be talking about volatility as an asset class. Advisors and investors have been taught forever the importance of having multiple asset classes in their portfolio to diversify their risk. Equities, bonds, real estate, and cash have been the cornerstones to modern portfolio theory for generations. Historically, bonds have been a key asset in risk diversification due to its negative relationship to equities. Unfortunately for risk-averse investors, as rates have gotten closer and closer to zero and even negative, bonds have started performing just like the rest of the risk assets. Much like the world we live in, volatility too has changed. It's finally at a place where it can be held as an asset class to diversify risk appropriately if the right approach is used. Now, the VIX is a tool to measure implied volatility. Implied volatility is known to have a high correlation to the market in the opposite direction. This negative correlation has been a key reason as to why the VIX futures are so popular. Now, 15 years in, the VIX has matured to a place where it can be held efficiently as an asset class. However, the VIX is still completely misunderstood and even dismissed because of poor execution of traders and investors who have not understood how to best utilize volatility. The VIX futures are very hard to understand for someone who's not been following them like a market maker. They move independently of the VIX index and are only predicting the closing price on expiration. They still are very highly correlated with the VIX index, but that correlation changes the longer the time period until expiration of the future. Owning volatility as an asset class via implied volatility is different than other asset classes too. Critically, volatility has no long-term positive expected value. While most asset classes over the long term will trend higher, the VIX ultimately will wind up in the same spot. The VIX is mean reverting. That means the higher the VIX goes, the harder it is to go higher. The lower the VIX goes, the harder it is to go lower. Putting it all together, the VIX has a very high negative daily correlation to the market. However, the longer the time frame, the more negative correlation evaporates until ultimately we find no correlation to the market at all. This means that owning the VIX is not a buy and hold strategy. It doesn't help any long-term performance. The solution to owning volatility as an asset class is to make it as simple to understand as possible. The VIX futures position should be actively managed and actively traded. To stay long the VIX, we need to accumulate it on drops and reduce it on rips. Keep it simple, stupid. Actively trading the VIX with a long risk asset such as stocks keeps a portfolio appropriately risk hedged. When the VIX spikes is when I like to harvest the returns of being long volatility and put it back into stocks. Buy stocks lower, sell volatility higher. Tragically, it seems that most people utilizing the VIX are hoping the market is going to zero and the VIX going to infinity. I don't think that approach is very realistic. I think the realistic view is that the market is not going to zero. Instead, it'll trend higher over time. For Equity Armor Investments, I'm Joe Tigay.